An easier way to manipulate the silver price is to stack short the futures market
Mm.
because it's so leveraged, and then use borrowed capital to manipulate down for a very brief period of time the physical market. That the physical market sends a signal to the futures market. You can impact, for a million ounce sale, you can impact a 200 million ounce forward position by doing that.
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pin comment. Stay ahead of the curve. Don't miss out.
What gold is meant to do is maintain your purchasing power over time. And gold has done a wonderful job. You know, Danny, not too long ago when you interviewed me, I made a wisecrack about when is gold going to move. And my answer was it was going to move in the year 2000. Mm-hmm. 2000, it was $250 an ounce. Now it's $3,000 an ounce. It's up almost 9% compounded over 25 years. That's what I'm looking for. The fact that gold is above 3,000 doesn't matter to me. I'm not a trader. I own gold, not because I thought it might go through 3,000, but because I was afraid it was going to go through 9 or 10,000. What we're seeing is gold defending you against the deterioration of the purchasing power of your savings and investment assets in US dollars. People need to get that. It's okay if you want to trade this stuff. It's okay if you want to speculate in junior mining stocks. But the idea that gold went from $2,700 to $3,000 is of no consequence whatsoever. It's the fact that gold went from $250 to $3,000 over 25 years that matters. And that matters a lot. I'm not so sure that that connection is real. It is, to be sure, real that when inflation is ripping, the cost to produce both gold and oil go up. So there are supply challenges in both circumstances. Oil is an industrial material. It gets used. From my point of view, gold is money. It's very different.
Right.
It is a medium of exchange and a store of value. Gold stores well. Oil's too big and too bulky and too cheap. Oil's utility is making cars go around or making chemicals. I think it's a very, very, very different commodity. I'm an oil and gas investor, although I don't own oil physically. I own oil stocks, and I think it's a superb investment for the next 20, 25 years. But it occupies a very different place in my portfolio than gold does. Gold in my portfolio is part insurance, part money. Three plausible explanations. One, the first explanation, which I think is partly true, is that people who want to get Europe out of gold and into the United States, or Americans that want to take delivery of gold, are afraid that a tariff will be applied to gold by Trump, and they're trying to beat the tariffs. A second problem, and a second possible explanation, is that the paper gold market, which is to say the futures market, commonly trades in one day 100 times the amount of gold available for good delivery. For 40 years, that hasn't particularly been a problem because gold has been at best directionless. But now that gold is directional, the idea that somebody's paper position in gold could be an unsecured obligation, and that as a gold option holder, you actually don't hold title to the gold, I think has bothered some people. I think that some people who want large quantities of gold have decided that they're going to have physical rather than paper delivery for their gold. And the idea that a deposit receipt in Switzerland is collateral for good delivery on the COMEX is, I think, from a lot of people's view, problematic. They want, physically to have their gold. The third thing is that the big institutional players are beginning to understand that the asset class is less liquid. There has been concerted buying of gold for 3.5 years by foreign central banks. And it is arguable that the existing hold of stock, whether or not available for good delivery, is insufficient, at least in the near term, to discharge all the charges against it. It's related to the first. If you have, 1 million ounces of gold, as an example, in some high quality vault, but that gold has been hypothecated and rehypothecated. If you believe that you own that gold, you don't want any chain of possession on your title. You want the gold. And I think all of those reasons combined have led to disintermediation from private storage and from LBMA stocks to physical possession in the United States and other centers. I think that'll happen for theatrical purposes, and I think it needs to happen. It doesn't matter much. I mean, people need to understand that. People say, well, we have $36 trillion in debt. We could handle that by revaluing the gold. Well, that's not true, because we're not going to use the gold to honor the debts. The debts are unsecured. It doesn't improve our balance sheet, really. It just improves the theatrics. A more important question, I think, is, by the way, I do think the gold will be revalued, because I think theater matters. Probably fair market value. I mean, if you could say that the value of the stuff went from I don't know, whatever it is, to a couple $1 trillion, it would make people feel better about the fact that we owe $36 trillion. It wouldn't matter. Right. But politics is all about making morons feel good. That's the point. Mm-hmm. A more important question, I think, is the gold there, and who has title? Right. I'm inclined occasionally to take the government at its word, but since the gold hasn't been audited for 40-something years, I think it's right that the gold be audited. Sprott audits their gold every year. The technology exists for this. Basically, it's 1 bar, 2 bar, 3 bar, 4 bar. Count the bars and test a few. And while you're at it, give us a title opinion. Whose gold is it? Did you borrow it from somebody, or is it actually our gold? If you're going to revalue it, how much is it? Who owns it? What is it worth? I'm much more interested in the audit and the title opinion than I am the revaluation. If you tell me, backed up by an audit, that my government has X million ounces of gold, I can revalue it. I've got a calculator. I know how to do that. I would really be curious. And when I say an audit, I don't mean Donald Trump performing theater, walking through Fort Knox, petting the bars with his camera out, taking a video. I don't want a trust me thing. I want KPMG or PricewaterhouseCoopers or somebody like that, not the Congressional Budget Office. I want a third party walking through there and conducting a proper audit. At Sprott, we did it every year. It made our shareholders feel better. It made our trust holders feel better. And to be honest with you, as a director, it made me feel better too. An easier way to manipulate the silver price is to stack short the futures market because it's so leveraged, and then use borrowed capital to manipulate down for a very brief period of time the physical market, so that the physical market sends a signal to the futures market. You can impact, for a 1 million ounce sale, you can impact a 200 million ounce forward position by doing that. I suspect that because the physical price of the Sprott Physical Trust can become disconnected to the price of the underlying commodity, unlike an ETF, which, unless the ETF blows up, always adds or subtracts silver and or deposit receipts, which is to say derivative silver, that an easier way to express your preference about the silver price is through the Sprott Physical Trust. Because the ETFs rebalance every day, unless they had a real crisis, there is no disconnect between their price and the silver price. And the shorts are probably trying to take advantage of the relative liquidity of the Sprott Physical Trust. But in particular, they're probably trying to take advantage of the fact that the silver price and the Sprott Physical silver price becomes disconnected. The New York Stock Exchange is certainly a wonderful place to express your preference for or against, because of the incredible trading liquidity and because of the leverage, the leverage that's offered. In other words, you can easily borrow a position on the New York Stock Exchange to short, and you can easily cover if you need to. So it's a wonderful place to express your preference. I think the institutional owners, at least the newcomers to the space, what I call the tourists, the generalists, are less concerned about the asset composition of the ETFs. When Eric Sprott set up PSLV, he wanted to make sure that every share of PSLV represented physical ownership in vaults. And he was unwilling to include as a temporary measure delivery receipts. He wanted physical silver. He didn't want our trust to be an unsecured creditor of a third party, an HSBC or a Barclays. I think that the institutional investors are less untrusting than Eric Sprott was. They want an instrument which tracks the price of silver, irrespective of the composition of their holdings. The holders of PSLV are very much more people of Eric Sprott's mind, people who own physical silver because they disconnect the financial system, and they don't want their shareholdership to be a call on somebody else's silver, but rather almost a delivery receipt evidencing ownership of silver itself. So it's a very different kind of investor. Well, first of all, I don't believe in ratios. The prevalence of gold or silver in the Earth's crust, 16 to 1, does not go to value, does not go to utility. While it's an interesting rule of thumb, I think it's a rule of thumb that isn't relevant to very much of anything.